Okay, I want you to try a little experiment with me. Close your eyes. Now, picture CVS. What's the first thing that pops into your head?
Oh, I can tell you exactly what it is. It's fluorescent lights, a distinct smell of rubbing alcohol and candy, and a receipt that is roughly the length of a medieval scroll.
Exactly. The corner drugstore. That is the image baked into our collective consciousness. But today, we are going to take a sledgehammer to that image.
Hmm.
Because if you're still thinking of CVS as just the place you panic buy greeting cards, you are missing one of the biggest business stories in America.
That's right. We're talking about a company that has, fundamentally reshaped itself. We're looking at their Q4 2025 earnings report, which just dropped this morning, February 10, 2026.
And the scale is just, it's hard to process.
It really is. The scale of this thing is actually hard to wrap your head around.
Give us the headline number just to set the stakes here.
$402 billion.
Wow.
That is their full year revenue for 2025.
400 billion. That's bigger than the GDP of most countries. It's absolutely staggering.
It puts them in the absolute stratosphere of the Fortune 500.
Yeah.
So the mission for this deep dive isn't just to look at a spreadsheet. It's to understand how this massive, diversified healthcare giant is trying to reinvent itself.
Right.
From a retailer into, and I'm quoting their CEO, David Joyner here, America's most trusted healthcare company.
Which is a massive ambition, especially considering where the world is right now. It is 2026. Medical costs are skyrocketing, regulations are tightening, and, everyone is feeling the pinch.
For sure. So you got the earnings release, the transcript from the call with Joyner and CFO Brian Newman, and the slide deck.
Let's start with the report card. Did they actually pass the test this quarter?
They did. And I think the word of the day here is resilience. You have to remember, 2024 and early 2025 were pretty turbulent for CVS, but this quarter, they steadied the ship.
Okay.
For Q4 2025, revenue came in at $105.7 billion. That's up 8.2% compared to the same time last year.
And usually when revenue goes up that much in a mature company, you worry about margins. Did they actually make any money on that?
They beat expectations there, too.
Yeah.
Adjusted earnings per share EPS came in at $1.09.
Okay.
Wall Street was expecting about $1, so beating that by 9 cents is a significant signal that management has their hands firmly on the controls.
So the headline is that the ship is stable, but I want to go below deck. I want to see the engine room because that is where the real story is.
Right.
And I want to start with the part of the business we all think we know, the retail pharmacy. Because for the last 5 years, the narrative has been retail is dead, everything is going online.
That has absolutely been the prevailing wisdom. But if you look at these numbers, the death of retail seemed to be greatly exaggerated. CVS's retail and wellness segment revenue was actually up 12.4%.
Double-digit growth in a brick-and-mortar business. That feels almost impossible in this economy. How did they pull that off?
Well, it wasn't just organic growth. A huge driver here goes back to a strategic move they made regarding Rite Aid.
Right, the Rite Aid acquisition. But they didn't just buy the stores and keep the sign up, right?
No, and that's the smart part. They acquired the prescription files.
Ah.
Essentially, they bought the customer base without necessarily taking on the baggage of every single physical location.
So walk me through the impact of that.
It was a migration. They brought 9 million new patients into the CVS ecosystem.
9 million.
9 million. Just imagine the logistics of that. 9 million people whose prescriptions were at Rite Aid are now being filled at CVS.
That is an instant, massive injection of recurring revenue.
It is. And they had to hire about 3,500 new colleagues just to handle that volume.
Yeah.
But the metric that really blew me away was same-store pharmacy sales.
Okay, the Holy Grail metric.
Right. In retail, that is the Holy Grail metric. It was up over 19%.
19%. That is unheard of.
It really is. They now hold over 29% of the entire retail pharmacy script share in the United States.
Oh, wow.
Almost 1 in 3 prescriptions filled in this country goes through a CDS. That is market dominance.
But holding the market is one thing, making money on it is another. We know pharmacy margins have been getting squeezed for years by reimbursement rates. It feels like a race to the bottom.
It does.
Did they talk about fixing that?
They did, and this is probably the most dense but important part of the retail story. It's a concept they call cost vantage.
Cost vantage. It sounds like something you'd see on a PowerPoint slide and immediately zone out. But why does this actually matter?
Because it changes the fundamental plumbing of how a pharmacy gets paid. Historically, the price of a drug at the counter was a black box. It was based on average wholesale price minus some discount plus a fee. It was volatile and opaque.
And usually that opacity worked against the pharmacy.
Exactly. CostVantage is a shift to a cost-plus model. It's transparent. CVS says, here's what the drug cost us, here's a set markup, and here's a service fee.
It takes the mystery out of it.
It does. It makes the revenue predictable.
And that's the key.
Precisely. They've completed the transition to this model for their commercial and government plans. And for the listener who might be an investor, this is huge. Management explicitly said this establishes a new trajectory, where retail earnings should be at least flat starting in 2026.
I love how flat is considered a victory here.
Well, when you've been on a downward slope, flat is the new up. It means the pharmacy business stops being a drag on the company and becomes a stable cash cow that funds everything else.
Okay, so the back of the store, the pharmacy is stabilized. But what about the front of the store? I'm talking about the toothpaste, the greeting cards, the vitamins. Inflation has been crushing consumer spending.
It has, but CVS made a tactical pivot here. Prem Shah, who runs the pharmacy and consumer wellness side, specifically called this out.
What do you say?
He mentioned that they lowered prices on everyday essentials to drive foot traffic. He actually singled out milk.
Milk, the classic loss leader.
The oldest trick in the book. You drop the price of milk to get them in the door, and maybe they buy a high-margin beauty product on the way out. And the data shows it worked.
Really?
They posted their 4th consecutive quarter of front-store comparative growth.
In a world where Amazon delivers toothpaste in 2 hours, getting people to physically walk into a store 4 quarters in a row is impressive.
It shows that the convenience factor of the corner store is still a powerful economic force.
Okay, so retail is alive and kicking. But we know that the real financial engine and the source of the most controversy is the PBM Caremark.
The invisible engine room.
For the listener who doesn't spend their weekends reading healthcare policy, let's just quickly define what a PBM does.
Sure. PBM stands for Pharmacy Benefit Manager. They are the middlemen. They sit between the drug manufacturer, the insurance company, and the pharmacy. They negotiate prices. They decide which drugs are covered. They process the claims.
And right now, the PBM is basically the villain in everyone's story. Politicians, patients, doctors, everyone blames the PBM for high drug prices.
Right.
How did CVS address this in the call? Did they hide from it?
Quite the opposite. CEO David Joyner went on the offensive. He really tried to flip the script.
Oh.
Instead of the villain, he positioned Caremark as the shield.
The shield? Protecting whom?
Protecting the clients, the employers and unions, from the drug companies. He threw out some numbers that were, frankly, shocking. He noted that in early 2026 alone, branded drug manufacturers raised prices on 750 different drugs.
750 price hikes.
Yeah.
In 1 month.
Yes. And he estimated that those hikes added $25 billion in costs to the healthcare system.
Wow.
He also dropped this stat. The median launch price for a new drug is now hovering around $350,000.
$350,000. That is a house. That is a nice house in many parts of the country.
For one treatment.
For one treatment.
So Joyner's argument is, we aren't the problem. The manufacturers are the monopoly power. We are the only ones with the scale to stand up to them and negotiate that price down.
It's a compelling narrative, but is it just talk? Did they offer any proof that they can actually drive costs down?
They brought receipts. The biggest example they cited was Humira.
The arthritis drug. Blockbuster.
Right. For a decade, Humira was the best-selling drug in the world, and it was incredibly expensive. But recently, biosimilars, which are basically generics for complex biological drugs, came to market.
Okay.
CVS made a very aggressive move. They essentially kicked the branded Humira off their preferred list and moved members to a biosimilar.
That is risky, though. Patients hate switching medications. There's always that fear that the generic won't work as well.
That is the conventional wisdom. But CVS reported a 96% adoption rate.
Wow. That is essentially total conversion.
And because the biosimilar is so much cheaper, they claim that more than 80% of their members paid $0 out of pocket for the drug.
So the patient pays nothing, and the employer saves money.
They estimated over $1.5 billion in savings for clients.
$1.5 billion.
That is the case study they are taking to Washington. They're saying, look, this is the value of a PBM. We saved the system $1.5 billion on one drug.
Speaking of Washington, the regulatory heat is still there. Congress is constantly talking about transparency legislation to regulate these middlemen. Is CVS worried?
They seem to be taking a bring-it-on approach. They talked a lot about their true cost model, which is their answer to transparency. The subtext was essentially, we know the regulations are coming. We think they are manageable. In fact, we hope the legislation forces everyone else to adopt the transparent model we are already building.
That's a smart strategic pivot. Turn the regulation into a competitive moat. If you are already compliant, the regulation hurts your smaller competitors more than it hurts you.
Exactly.
All right, let's move to the third pillar of this empire. We've done the drugstore, we've done the drug negotiator, now the insurance company, Aetna.
The healthcare benefits segment. This has been the trouble child recently, hasn't it?
It has. 2024 was rough for Aetna. High utilization, higher costs. But looking at these Q4 2025 numbers, it looks like they've turned a corner.
It's a massive recovery.
Yeah.
Adjusted operating income improved by over $2.6 billion year over year.
$2.6 billion.
That is a huge swing back to profitability.
How did they do that? Did they just stop paying claims?
Well, that's always the cynical take.
Yeah.
But really, it came down to pricing discipline. They charged premiums that actually matched the risk, and they exited some markets where they just couldn't make the math work.
They got disciplined.
They got discipline.
So it's not all clear skies. There's a storm cloud on the horizon called the rate notice.
Ah, yes. The 2027 Medicare Advantage Advanced Rate Notice.
Try saying that 5 times fast. Why should the average listener care about a government rate notice?
Because it dictates the flow of money for millions of seniors. This notice basically sets how much the federal government pays private insurers like Aetna to manage Medicare plans. And right now, the industry is screaming that the government's proposed raise is way too low.
Too low meaning it doesn't keep up with inflation.
Exactly. The medical cost trend inflation, plus the fact that seniors are using more health care services, is rising faster than what the government wants to pay. If that gap persists, it squeezes Aetna's margins.
So CVS is stuck between hospitals raising prices and the government lowering payments.
It's a vice. Management said they were disappointed with the proposal and they are lobbying hard for changes before the final rates are set. But, and this is key for investors, they explicitly said they are not changing their margin targets.
Which implies they think they can find efficiencies elsewhere to make up the difference.
Or cut costs.
Speaking of efficiency, there was one statistic in the Aetna section that I think actually impacts regular people the most. It's about prior authorization.
The 2 most dreaded words in healthcare.
Right. You're sick, your doctor says you need a scan, and then you sit by the phone for a week waiting for an insurance company to say yes. It's the hassle factor. What is CVS doing there?
They are deploying AI and automation in a big way. They claimed in the call that 95% of eligible prior authorizations are now approved within 24 hours.
95% within 24 hours.
Yes, and they said many are done instantaneously.
If that is true across the board, that is a game changer for patient experience. That removes so much friction.
It seems to be resonating. Aetna won the inaugural Press Ganey Health Plan of the Year award. That award measures member experience and quality. So, despite the financial tightening, the service metrics are actually improving.
They're faster and more responsive.
Exactly.
So we have these 3 massive businesses, retail, PBM, and insurance. But the pitch for CVS, the reason they spent billions buying Aetna and these other companies, was synergy.
The idea that 1 + 1 + 1 equals 5.
Right. Are we actually seeing that?
This brings us to section 4, connecting the dots. It's about the ecosystem, and this is where the newer acquisitions like Signify Health come in.
Signify is the home health unit, right?
Yeah. Yes. They send clinicians into people's homes, about 3.5 million visits a year. But think about the power of that. It's not just a friendly checkup.
It's a data play.
It is a huge data play.
Explain that.
When a clinician is in your living room, they see things a doctor in a sterile office misses. Is the fridge empty? Are there throw rugs you could trip on? Are your pill bottles gathering dust on the counter?
And that data goes back to Aetna.
Exactly.
Yeah.
It connects the loop. Last year, Signify supported over 500,000 reconnections to care. That means they found a problem in the home and got the patient to a doctor before it became an emergency.
And preventing an emergency room visit saves Aetna a lot more money than the cost of the home visit.
Precisely. They also flagged 100,000 urgent escalations. That's 100,000 times they likely prevented a hospitalization. That is real impact.
Then you have Oak Street Health, which is their network of primary care clinics for seniors.
Oak Street is still small relative to the total $400 billion revenue, but its growing fast revenue was up 21%. But again, it's about what they call the flywheel.
Walk us through the flywheel.
Imagine an Aetna member goes to an Oak Street clinic. The doctor prescribes a drug. The patient picks it up at a CVS pharmacy.
Yeah.
CVS captures the premium, the doctor's fee, and the pharmacy sale.
So they get paid 3 times on the same patient interaction.
Yes, but it's deeper than that. Because the pharmacist knows what the doctor said, and the insurer knows what the patient bought. The data flows through all three. Adherence goes up, people take their meds.
Which keeps them healthier.
And significantly lowers the total cost of care for Aetna. It creates a closed loop. That is the holy grail they are chasing. Lower costs and better outcomes because they own every piece of the puzzle.
It makes sense on paper, but executing that across, 300,000 employees is a massive challenge. So looking ahead, it's February 2026. What are they promising for the rest of this year?
They are projecting stability. They reaffirmed their adjusted EPS guidance of $7 to $7.20 per share.
So steady as she goes.
Again, they expect to hit that $400 billion revenue mark again.
There was a little blip about cash flow though, right? I saw a note about that.
A small one. They lowered cash flow guidance slightly to at least $9 billion, down from 10. But Brian Newman, the CFO, was very clear that this is just timing.
Timing how?
Basically, some massive payments they expected to receive in early 2026 actually arrived in late 2025.
So the money isn't missing, it just showed up early.
Exactly. No alarm bells there. It's purely accounting timing.
And how did the market react? Investors can be finicky.
The stock was trading around $75.12 leading into the call. It dipped slightly, down less than 1%, but generally the reaction has been positive.
Okay.
After the volatility of the last 2 years, I think investors are just happy to see a boring quarter where promises were kept.
Sometimes boring is exactly what you want.
Especially when you are turning around a battleship in the middle of a storm.
So let's pull this all together. We have a retail business that has stabilized by swallowing up Rite Aid's customers and fixing its pricing model.
We have a PBM that is fighting drug inflation with biosimilars like Humira.
And we have an insurance giant that is rebuilding its margins despite government pressure.
And underneath it all, a massive tech and care delivery network trying to glue it all together.
So why does this matter to you, the listener? Because CVS is actively changing the plumbing of how you pay for drugs with Cost Advantage. They are changing how quickly you get approved for care with their prior auth tech.
They are literally in your home with Signify.
It's becoming inescapable, which leads me to our final thought, and this is something I want you to mull over. In the earnings call, CEO David Joyner really framed the narrative as CVS against the world. He said manufacturers and hospitals are incentivized to raise the cost of healthcare, and he positioned CVS as the defender of affordability.
The white knight of healthcare.
Right. But here is the question we have to ask. As CVS integrates deeper into every single aspect of your life, from your insurance card in your wallet to the doctor in your living room to the pharmacy on your corner, are they becoming the solution to a fragmented system?
Or are they simply becoming the ultimate gatekeeper?
That is the multi-billion-dollar question. When one company owns the diagnosis, the prescription, and the payment, is that efficiency or is that total control?
Something to think about the next time you're waiting for that 3-foot receipt to print.
Thanks for diving deep with us today.
Stay curious.